RBI has not cut rates in nearly 5 years. This is expected to be the first rate cut we see this time round in nearly 5 years. A 25 basis point rate cut is what is being priced in and expected by economists, brokerage firms, and of course the street. This becomes crucial. Some might argue not nearly enough. This becomes crucial at a time of a slowing economy. Remember, the GDP has come down consistently for the last 3 quarters for India, and the last quarter GDP was the lowest in 2 years, which is why this tonic boost of a rate cut is so crucial. The government, if you saw in the budget from the government side, the focus on fiscal consolidation is razor sharp. They have in fact lowered, not just met, but even lowered their fiscal deficit targets for this year and for the next. When the government is not going to come in and spend, how do you boost an economy? That's when the RBI comes in. If rates are cut, if liquidity is pushed, one could hope for a boost in the economy and in growth. That's what equity markets are watching out for this morning. Rate cut and liquidity measures from the RBI also become very, very important if a tariff war breaks out. Remember, right now, between US and China, tariffs have come into place and increased. We don't know how much it will spread. At that point, the Indian economy needs to be bolstered with enough liquidity. Core inflation has also shown some signs of deceleration, which means there could be the right time for a rate cut. In terms of the impact that a rate cut could have. All right, there we have the governor. Let's go.
The Monetary Policy Committee met on 5th, 6th yesterday, 7th today of this month. You are all aware that the governor's statement after the MPC meeting contains the resolution of the MPC with regard to the policy rate and stance. It also contains announcements and measures which have a bearing on the monetary and regulatory policies. The Monetary Policy Committee resolution is of course of interest to a large number of people from various walks of life. It impacts the lives of virtually all citizens of the country. The resolution also provides the rationale and the thought process of the MPC, and therefore is of relevance to businesses, economists, academicians, and the finance world. Apart from these MPC-related announcements, the governor's statement has become an important medium for the Reserve Bank to highlight its priorities on which it would like its regulated entities to focus their energies on. It is an opportunity to point out areas of concern and challenges for the stakeholders to address their attention to. It is an occasion for the Reserve Bank to articulate its views on critical areas of interest. I will continue with this practice of a detailed statement after each MPC committee meeting. Now, before I come to the resolution of the MPC, kindly allow me a moment to reflect on the experience of the flexible inflation targeting framework. You are all aware that this inflation framework was put in place in the year 2016 and it was reviewed in the year 2021. You are all also aware that this is a monumental change in the monetary policy history of our country. And so I thought it fit that I reflect on the experience of the flexible inflation targeting framework. Well, I believe that it has served the Indian economy very well over these years, including the very challenging period since the pandemic. The average inflation has been lower post the introduction of this framework. Moreover, CPI has mostly stayed aligned with the target given under this framework, barring a few occasions of breaching the upper tolerance band since its inception. We in the Reserve Bank and the Monetary Policy Committee will continue to improve the macroeconomic outcomes in the best interest of the economy, using the flexibility which is embedded in the framework. while responding to the evolving growth inflation dynamics. Moreover, we will strive to further refine the building blocks of this framework by making advances in the use of new data, improving nowcasting and forecasting of key macroeconomic variables. We forecast, you are aware, growth, inflation, etc., because this is actually a forward-looking policy. And so we'll continue to do that and develop more robust models. On the regulatory front, I would like to mention, and especially there has been a lot of media attention with regard to some of the proposed regulatory changes pertaining to liquidity coverage ratio, expected credit loss framework for provisioning by banks, the prudential norms governing projects under implementation. We will continue to strengthen, rationalize, and refine the prudential and conduct related framework. I think this is very important in the overall interest of our economy. The interest of the economy demands financial stability and consumer protection. Our mandate in the RBI is to enhance both of them. At the same time, I would like to emphasize that the economic interest also warrants increasing efficiency in the economy, and this too is our duty. We recognize that just like there are no free lunches, regulation to enhance stability and consumer protection too is not devoid of costs. There are trade-offs between stability and efficiency. We will keep this trade-off in mind while formulating each and every regulation. It will be our attempt to strike the right balance, keeping in view the benefits and costs of regulation. I also want to reassure all stakeholders that we will continue with the consultative process which the RBI has been doing over the years in this regulation making process. The suggestions of the stakeholders are very valuable, and we will continue to give serious consideration to them before taking any major decision. We will also ensure that the implementation of such regulations is smooth. We will give sufficient time for transition, and where regulations have major implications, the implementation will be done in a phased manner. Coming to the global economy, the global economic backdrop remains challenging. The global economy is growing below the historical average, even though high-frequency indicators suggest resilience, along with continued expansion in trade. Progress on global disinflation is stalling, hindered by services price inflation. With receding expectations on the size and pace of rate cuts in the US dollar has strengthened, bond yields have hardened, emerging market economies have witnessed large capital outflows, leading to sharp depreciation of their currencies and tightening of financial conditions. Divergent trajectories of monetary policy across advanced economies, lingering geopolitical tensions, and elevated trade and policy uncertainties have exacerbated financial market volatility. Such an uncertain global environment has posed difficult policy trade-offs for emerging market economies. The Indian economy, though continuing to remain strong and resilient, also did not remain immune to these global headwinds, with the Indian rupee coming under depreciation pressure, as you would have noticed in the recent months. At the Reserve Bank, I would like to assure all of you we have been employing all tools at our disposal to face the multi-pronged challenges. With this backdrop, let me now come to the Monetary Policy Committee resolution. As I mentioned, we met these last 3 days, concluding today. And after a detailed assessment of the evolving macroeconomic and financial developments and the economic outlook, as I mentioned, we are forward-looking. The MPC decided unanimously to reduce the policy rate by 25 basis points from 6.5% to 6.25%. I repeat, the MPC unanimously decided to reduce the policy rate by 25 basis points from 6.5% to 6.25%. Consequently, the standing deposit facility, SDF, the SDF rate shall be at 6.0%, and the marginal standing facility rate, also called the MCF rate, and the bank rate shall be 6.5%. The MPC also decided unanimously again to continue with the neutral stance and remain unambiguously focused on a durable alignment of inflation with the target while supporting growth. I shall now state the rationale for the decision in brief. The MPC noted that inflation has declined, supported by favorable outlook on food and continuing transmission of past monetary policy action. It is expected to further moderate in 2025-26, gradually aligning with the target. The MPC also noted that though growth is expected to recover from the low of Q2 of 2024-25 this year, it is much below that of last year. Last year, you are all aware, it was 8.2%. This growth inflation dynamics opens up policy space for the MPC to support growth while remaining focused on aligning inflation with the target. And accordingly, the MPC decided to reduce the policy rate, by 25 basis points to 6.25%. At the same time, the MPC felt that excessive volatility in global financial markets and continued uncertainties about global trade policies, coupled with adverse weather events, pose risks to the growth and inflation outlook. This calls for the MPC to remain watchful. Accordingly, it decided to continue with a neutral stance. This will provide MPC with the flexibility to respond to evolving macroeconomic environment. With this, now I come to the assessment of growth and inflation. First of all, growth. As per the first advanced estimates, real GDP growth for the current year is estimated at 6.4%. The numbers were released by MOSPI recently. This is a softer expansion after a robust 8.2% growth last year. Going forward, economic activity is expected to improve in the coming year. Agricultural activity remains upbeat on the back of healthy reservoir levels and bright Rabi prospects. Manufacturing activity is expected to recover gradually in the second half of this year and beyond. Early corporate results for Q3, and we have more than 50% of the results now as we speak. It indicates a mild recovery in the manufacturing sector. Mining and electricity are rebounding from monsoon-related disruptions in Q2. Business expectations remain upbeat, as evident from the PMI Manufacturing Future Output Index. Services sector activity continues to be resilient. PMI services, however, declined from its recent peak. On the demand side, rural demand continues to be on an uptrend, while urban consumption remains subdued, with high-frequency indicators providing mixed signals. And we are aware, we got the Nielsen survey report also just yesterday. Going forward, improving employment conditions, tax relief in the union budget, moderating inflation, together with healthy agricultural activity bode well for household consumption. Government consumption expenditure is expected to remain modest. higher capacity utilization levels, robust business expectations, and government policy support augur well for growth in fixed investment. Continued buoyancy in services export will support growth. Global headwinds, however, continue to impact uncertainty to the outlook and pose downward risks. Taking all these factors into consideration, the RBI has estimated that real GDP growth for the next year to be at about 6.7%, with Q1 at 6.7%, Q2 at 7%, Q3 at 6.5%, and Q4 too at 6.5%. The risks are evenly balanced. Coming now to inflation, headline inflation after moving above the upper tolerance band in October has since registered a sequential moderation in November and December, standing at 5.2% now. Going ahead, food inflation pressures, absent any supply side shocks, should see a significant softening due to good Kharif production, winter easing as we witness every year in the vegetable prices, and a favorable Rabi crop prospect. Core inflation is expected to rise but remain moderate. Rising uncertainty in global financial markets, coupled with continuing volatility in energy prices and adverse weather events, presents upside risks to the inflation trajectory. Taking all these factors into consideration, CPI inflation for the current financial year is projected at 4.8%, with Q4, the current quarter, at 4.4%. Assuming a normal monsoon, CPI inflation for the financial year 2025-26 next year is projected at 4.2%, with Q1 at 4.5%, Q2 at 4%, Q3 at 3.8%, and Q4 at 4.2%. The risks are evenly balanced. I will now come to the external sector. The India's current account deficit moderated from 1.3% of GDP in Q2 of last year to 1.2% in Q2 of this year, 24-25. According to the World Bank, India, with an estimated inflow of $129.1 billion US, continues to remain the largest recipient of remittances globally last calendar year 2024. The current account deficit for this year is expected to remain well within the sustainable level. As on 31st January this year, I may inform you, India's foreign exchange reserves stood at 630 plus billion US dollars. This provides us an import cover of more than 10 months. Overall, India's external sector remains resilient as key indicators stay robust. I would like to mention over here, and especially because there has been commentary in the media about the Reserve Bank's exchange policy. Well, the Reserve Bank's exchange rate policy over the years has remained very, very consistent. Our stated objective is to maintain orderliness and stability without compromising market efficiency. The Reserve Bank believes in the market efficiency of the markets that we have in India for Forex. Accordingly, our interventions in the Forex market focus on smoothing excessive and disruptive volatility. It does not target any specific exchange rate level or band. The exchange rate of the Indian rupee is determined by market forces, and we will continue with this policy. Coming now to liquidity and financial market conditions, I may state that after remaining in surplus from July to November 2024, system liquidity as measured by the average net position under the liquidity adjustment facility did turn into a deficit during December 2024 and January 2025. This drainage of liquidity is mainly attributed to advanced tax payments in December 2024. You are aware there are quarterly advanced tax payments to be made, December being that particular month. For the advanced tax payments for Q3, that did have an impact. Capital outflows, again, one has witnessed some capital outflows because of various reasons. Forex operations and a significant pickup in currency in circulation as we witness every year in January. It has been, however, I would like to mention over here that we have observed that some banks are reluctant to on-lend in the uncollateralized call money market. They are passively parking funds with the Reserve Bank. I take this opportunity to all the banks to urge them to actively trade amongst themselves in this uncollateralized call money market, so as to make it deeper and vibrant for better signal extraction from the weighted average call money rate. The Reserve Bank is committed. I want to assure everyone that the Reserve Bank is committed to provide sufficient system liquidity. We have taken a number of steps in this regard, and we will continue to monitor the evolving liquidity and financial market conditions and proactively take appropriate measures. I repeat, proactively take appropriate measures to ensure orderly liquidity conditions as may be required for the system. And when I say liquidity, it means not only transit overnight liquidity, but also durable liquidity to meet the requirements of the system. I now come to financial stability. The system level financial parameters for the scheduled commercial banks continue to be healthy. The credit deposit ratio for the banking system at the end of January 2025 was at 80.8%, broadly similar to that on 30th September 2024. Bank liquidity buffers are sufficient. Though the net interest margin moderated, return on assets and return on equity are robust. The system level parameters for NBFCs too are very healthy. I also take this opportunity today to mention that the Reserve Bank has been observing Financial Literacy Week annually since 2016. This is with the purpose to enhance financial education in our country. Last year too, we did this campaign. This campaign was focused last year on empowering youth adults. This year, recognizing the critical and multifaceted role of women in society, this campaign will emphasize on women's role in financial decision making and household budgeting. I sincerely urge all banks to actively participate in this campaign on the theme Financial Literacy, Women's Prosperity. It starts from 24th of this month. Now, before I conclude, I shall be announcing some additional measures. Necessary directions and circulars for these shall be issued separately. First of all, on digital security, the rapid digitalization of financial services has brought convenience to all of us, at the same time efficiency, but it has also increased exposure to cyber threats and digital risks, which are again getting sophisticated day by day. The surge in digital frauds is a matter of concern. It warrants action by all stakeholders. The Reserve Bank has been taking various measures to enhance digital security in the banking and payments system. Introduction of additional factor of authentication for digital payments is one such measure. It is now proposed to extend this to online international digital payments made to offshore merchants who are enabled for such authentication. Second, the Reserve Bank shall implement the bank.in exclusive internet domain for Indian banks. Registration for this domain name will commence from April this year. This will help avoid banking frauds. This will be followed by the fin.in domain for the whole of the financial sector. The banks and NBFCs, I would urge them to also continuously improve preventive and detective controls to mitigate cyber risks. They must develop robust incident response and recovery mechanisms, reinforced through periodic testing for operational resilience. Third measure that I am announcing today, over the past few years, we have expanded the suite of interest rate derivative products available to market participants to manage their interest rate risks. We shall now, to this suite, include forward contracts in government securities. This would facilitate long-term investors, such as insurance funds, to manage their interest rate risk across interest rate cycles. It will also enable efficient pricing of derivatives that use government securities as underlying instruments. Fourth, to enhance access of retail investors to government securities, the Reserve Bank has taken a number of steps earlier. There's another step, that I am announcing today, and this pertains to expanding the access of NDS Home, our platform for trading in the secondary market transactions for government securities, to non-bank brokers who are registered with SEBI. A number of them are registered with SEBI. They will also get an opportunity now to participate and trade through the NDS Home, the electronic trading platform of RBI for government securities. Fifth, in view of the various developments in financial markets and market infrastructure over the past few years, we shall be setting up a working group with representation from various stakeholders to undertake a comprehensive review of trading and settlement timing of markets regulated by the Reserve Bank. There are some 5 such markets which have different timings. The group shall submit its report by 30th April this year. To conclude, considering the existing growth inflation dynamics, the MPC, as I mentioned earlier, while continuing with the neutral stance, felt that a less restrictive monetary policy is more appropriate at this current juncture. The MPC will take a decision in each of its future meetings based on a fresh assessment of the macroeconomic outlook. We are committed to conduct monetary policy and take such measures as appropriate, which are timely, carefully calibrated, and clearly communicated to facilitate conducive macroeconomic conditions that reinforce price stability, sustained economic growth, and financial stability. Thank you, Namaskar, and Jai Hind.
All right, that was the first speech from Governor Malhotra after taking charge, and of course the 25 basis point rate cut came, of course a tweak in rates as expected, but Neeraj, no poem, no quote in the end, just to see what the new governor's style is. I would say very to the point, very business-like, very, very specific. Set Q3 numbers have come in, and business as usual, and means business.
So 25 unexpected lines. I thought, reasonably dovish, if you will, maybe not as much, but I think our guest will be better placed. But 25 basis points was the need of the Arthamana, so I think that's done. And let's see if there are any other non-policy measures taken in the run-up to March.
I would not call it dovish. I don't know. But we'll ask Katrina L. I will ask Katrina L joining us, Director Economic Research, Moody's Analytics. It's so great to have you on the show, Katrina, as we break down what the monetary policy is talking about. Neeraj and I, since this morning, have been debating on whether this will be dovish commentary or not, because the 25 basis point rate cut was largely expected. Would love to know your take on that and your first reactions.
Yes, I think it's a positive development that the RBI has finally decided to cut rates and deliver that 25 basis point reduction. I think what's clear is that, there's a really difficult balance that they've got at the moment. On the one hand, they do have, domestic demand, which does need that additional support. But on the other hand, they do have that really weak rupee that they're balancing as well. And it seems through today's decision that they are prioritizing strengthening and working towards improving domestic demand over the next couple of months. So in terms of forward guidance, I'm not sure at this point we can be really clear of whether this was a dovish or not, because let's remember that this decision was largely anticipated by markets. And I think that the RBI is treading really carefully about any forward guidance, just because there's a whole lot of uncertainty in the external environment, particularly around tariffs and how inflationary or not they will be, and also the potential implications of that weak rupee and how that's going to feed through to domestic inflation in India. So I think they're continuing to tread really carefully and will be guided by the data, in particular the inflation data and also the growth related data as well, to see how quickly they need to continue with this easing cycle.
Some calls to banks as well, by the way. So that was the interesting piece and watch out for. But Aditi Nair is here. Aditi, what did you make of the policy statement? 25 basis points on expected lines. Would you call this a dovish policy, a neutral policy with a rate cut? How would you classify it? And what stood out from the statement for you?
So I definitely won't call it dovish. He did mention upside risks to inflation. I think there was a very hopeful note which was struck in a sense, talking about resilience amidst global uncertainties, etc. But it was a very pragmatic policy, and I think overall very much in line with what we were expecting, that we'll get a rate cut without any change in stance. And even towards the end, the mention that we're going to look at the outlook every single time to decide what we're going to do. I think that's absolutely the right approach. In any case, this rate cut cycle is expected to be very shallow. We're not expecting more than one more rate cut. So there's very little point actually to change the stance to accommodative. So I think it's much better that we've retained it at neutral. And this gives all the flexibility to the MPC to decide policy after policy what looks best for the Indian economy. And a couple of more points, 4.2% CPI inflation for next year, that's in line with our own estimate. And what that's basically suggesting is that neither are the tax cuts expected to be very inflationary. And while, of course, the upside risks to inflation were mentioned, but again, similar to our own view, that the exchange rate depreciation will have a much bigger impact on the WPI and a smaller and more lagged and delayed impact on the CPI. So while upside risks were mentioned, the CPI inflation projection actually for FY26 has been mentioned at 4.2%, which is in line with our own extant projection as well.
Aditi, hi, Tamanna here. Just wondering on what you made of the GDP forecast and the inflation forecast. They've stuck to the inflation forecast. I think GDP second quarter has been tweaked down a little. Just your reading into where Governor Malhotra thinks growth will go.
So actually, the GDP growth forecast, I think, is a little bit on the higher side. We are at 6.5% each for FY25 and FY26. I suppose the MPC has just taken the NSO first advanced estimate of 6.4% instead of giving a new estimate now.
Aditi, sorry, Aditi, you will have to excuse me. So sorry, I just want you to complete your statement, but we have Mr. KK Mistry on the phone line, so I'll have to go to him for a minute and get his view first, and then we'll continue the conversation. Mr. Mistry, thanks for joining in and taking the time out. What did you make of this? Not dovish seems to be a consensus.
I think completely along expected lines. That given the global economic uncertainty, the trade wars going on, and all of that, the stance remains unchanged, and a 0.25% reduction in interest rates will help hopefully help boost growth further. That coupled with the fact that existing home loan customers will get the benefit of the 25 basis points cut in rates, particularly, obviously customers who are linked to the repo rate, which is the bulk of the customers. So all in all, as expected, good policy. The stance continues unchanged, and I think we will now start seeing the growth pick up in the system.
Mr. Mistry, hi, Tamanna here. In terms of the outlook we saw from the governor, and I'm asking you this because the 25 basis point rate cut was widely expected, priced in by the market and everyone who watches this event very closely. But on the outlook of whether we will see another 25 or another 50 basis point this calendar year, what sense did you get from what Governor Malhotra was saying? And of course, his first speech was being watched very, very closely.
I think the governor said that growth is picking up in the system. He also said that the outlook on inflation is neutral. I don't think he seemed to be very worried about inflation. And if we had good monsoons next year, then I think you would see 2 more rate cuts of 25 bips each. If you don't see good monsoons, my expectation is about 25. So anything between 50 and 75 for the year would be my expectation, depending on data, depending on how things work out.
Are you in agreement with the growth outlook? Just before we came to you, sir, Aditi Nair was giving her view that she thinks that the growth outlook is a little on the optimistic side. Are you seeing yourself signs that there would be this kind of a recovery in growth?
I think there will be a recovery. I personally think, and I may be differing from the earlier view, I think you may see even a pickup in growth beyond the 6.7% that RBI talked about for next year. You could see 6.7 probably getting closer to 6.8, or if you are lucky, maybe a little more than that. Obviously, depending upon good monsoons and the macroeconomic environment in the rest of the world not getting completely beaten down.
Mistry, would you have, considering that March is around the corner and liquidity conditions, though RBI has done enough measures, but would you have hoped for some more measures around liquidity specifically to be announced, or can they be done beyond the policy as well?
We've seen that liquidity measures are always usually announced beyond the policy. The only liquidity measure really announced in the policy is a cut in the CRR rate. We saw a cut in the CRR rate in the last policy. And therefore, I don't think one would have expected a CRR cut this time. But you saw that a couple of weeks ago, not even a couple of weeks ago, about 8-10 days ago, RBI, through these OMO operations, has injected or will be injecting a lot of liquidity into the system. This quarter also important because this is the 4th quarter and you will see the largest installment of advance tax being paid in the current quarter.
Got it. Mr. Mistry, just one last question from mine. In the 2 instances that you spoke about your constructive opinion on growth, you mentioned domestic factors completely. Could global growth worries bring a question mark to even the RBI's estimate? Forget your assessment that it could be higher as well.
Look, I think globally we are living in a world of complete uncertainty. No one knows what's going to happen 3 months, 4 months from now. We've never seen this kind of global uncertainty any time in the near future.
Right.
So global factors will affect our growth all over the world. India will be least affected. I repeat, least affected compared to any other big country, simply because our domestic economy is very strong. And the measures taken in the budget in terms of leaving money in the hands of people will push consumption. If consumption picks up, local consumption picks up, then that itself will create need for more capacity, more products being produced, and therefore more investment. So whilst there will be an effect, I still think that despite the global environment, we should still be looking at a growth maybe marginally higher than what RBI has said. Unless there is a very major global catastrophe, which we can't predict, or oil prices shoot up beyond what we are expecting.
Just one last point, Mr. Mistry. Are you expecting a fair enough pass-through of this rate cut? Because that always becomes the question.
I would think so. I mean, the rates, the repo rate, most of the loans are now linked to repo rate, particularly the housing loans. So there it is absolutely automatic.
Okay, thank you so much. KK
Thank
Mistry
you very
there on his first view on the policy. Let me come back to Aditi Nair. And Aditi, sorry we had to interrupt you there because we just had that 2 minutes with Mr. Mistry. But do complete your point. And I think it's an important one to underscore why you think that the RBI is maybe being a little optimistic on the growth outlook.
So just to kind of go back a step, certainly we expect growth is going to rebound from the lows that we saw in Q2. There's no doubt about that. For FY25, the NSO has placed the advanced estimate at 6.4%, which the MPC has probably taken as a given right now. And that's what they normally do. Then they don't give a fresh estimate of their own for the current year once the advanced estimate is there. So on 6.4%, they've indicated a 6.7% growth for next year. Our house view at ICRA baseline view is 6.5% each for both these years. So that's why I'm saying they're a tad higher than where we are. And at 6.7%, they're actually quite close to the upper end of the Eco Survey's 6.3 to 6.8% range as well. Domestic demand is recovering. Rural is expected to be better, much steadier this year. Urban demand should also recover, particularly the unevenness that we saw at the middle and the bottom of the pyramid. That should recover post the budget based on both the tax cuts, which will help part of the urban economy, and all the other measures as well, which we think will also be supportive. But it will mainly be domestic demand and the government capex, which is going to drive growth. We hope private capex will come back stronger in FY26. But that really remains to be seen. Does it continue at the modest sort of pace that we're seeing right now, or does it amp up substantially, given the kind of global uncertainties that we have that are going to have an impact on merchandise exports? How soon will we really know what is the exact tariff implication on India vis-a-vis other countries? That's very important. Do we end up getting bucketed with the BRICS? Do we escape that? Do we have any tariffs imposed on Indian exports at all? Are they less or more or equal to other countries? There are too many unknowns. So we don't really expect merchandise exports to be a driver of growth. As of now, services exports are still doing very well. So that is something that will continue to be supportive.
Got it. Okay. Well, Katrina, Aditi, please stay on. We've got a battery of other guests joining in as well. And two people who got it absolutely right. Jaideepa had spoken about this way back, that maybe some liquidity measures first and then a rate cut in February. It's come out. Jayesh Mehta 3 days ago joined us, spoke about the crossing fingers of a rate cut coming through, and that has come true. So both of you would be happy. Jayesh, I'll start with you. Is this coming exactly with what you anticipated, or would you have hoped for something more in the policy?
No, that's exactly as anticipated. And in fact, one more change, I would say, if you really look at the MPC policy, when we said flexible inflation targeting policy, that was supposed to be flexible. That doesn't mean that we have to go to 4. If your real rate is too high, even at 5%, if the real rate is too high and the growth is struggling, you have room to cut rate, and which is what they have done this time around. And that's why I actually look at it, there is more scope, because if you look at and one more thing he also said is forward looking, right? So if you look at their inflation projection for the next year, and if nothing changes in April policies, we can actually see, further rate cut because even at 6th quarter, and if you look at the projection of around 4.2, we are at 2%, almost 2% real rate, right? And therefore, there is enough room to cut that rate and no need to wait for 4% to come through.
Got it.
So that's a big challenge.
Yeah, well, it certainly is. Okay, so that's as Jayesh's take, and I'm sure, more questions for our panelists, but quickly getting a take from Vishwanath Nair, our banking editor, who's right there at the RBI headquarters. Wish you got the chance to read the whole statement as well. Quick takeaways.
Quick takeaway, the last bit that the RBI governor said right before he left the room was a less restrictive monetary policy was warranted. That's what the MPC felt. And while he said that for future policies, we will take a fresh look at data and then decide what we want to do in the upcoming policies. But this was a clear indication, according to me, that there is a likelihood of a sort of a dovish stance coming in from the Reserve Bank governor on future rate actions. Another important point, and this is something that I want to ask Jaideep Iyer at RBL Bank as well. He's pointing out specifically to banks, saying that you're parking too much money with the RBI passively, and that you should use that, participate in the call money market and on-lend it to other lenders. I want to ask Jaideep, is that in your view a significant problem at this point in time, and maybe some of the liquidity issues that the banking system is facing could be resolved partly through the system itself redistributing that liquidity?
Hi, morning everyone. Thanks, Rationale. I think honestly, I don't think call money is a big issue from a banking sector standpoint. I think generally we've seen very less demand in call money, because it is generally not being considered good for banks to borrow in call money, and therefore there is no demand, and therefore even the lending doesn't really happen. So at one point in time, several years back, the call money market was a fairly large market, and I think it's now fairly insignificant and irrelevant, because it's also associated with a little bit of let's say, negative liquidity scenario at a specific bank level, and therefore banks have generally avoided taking access to call money markets in general.
Okay. Okay.
This is a big deal.
Yeah. Okay. We'll come back to Vishy for more on this. Alok Singh also joining in Treasury Head, CSB Bank. Mr. Singh, thank you so much for speaking with us. Just your first take on the policy and the outlook. Before the policy announcement, everyone was very sure about 25 basis points, and then there was a varied view on whether 50 to 75 this calendar year. Just wondering if you have rejigged your assessment for rate cuts as a total this calendar year after listening to the governor.
Yeah, good morning and thank you. So I believe my outlook on policy is that it was a very balanced view given the conditions prevailing, especially in the dollar rupee market. So dollar rupee, if you see, has depreciated by more than 3%, I think, in the last couple of months, which is a significant move. And that is inflationary as well. So 25 was factored in, and I believe that the statements hinge towards the dovish, and we believe in the policy stance for the economy. We believe that the liquidity and the rates work hand in hand. You cannot. So RBI has already started addressing the liquidity conditions. You have seen the announcements in last couple of weeks, and they have given the cut now. But having said that, I still believe that going forward, the rates cut are embedded. They will come. But looking at US scenario, how the rate scenario is panning out, where it's believed that they will hold for some more time. And similarly, even the Bank of England spoke yesterday. So we will have to look at a global perspective as well. And looking at that, keeping the neutral stance, and then probably taking a better call in April would be more prudent. And I believe that at least 2 rate cuts are more there in the policy stance in next 1 year.
Okay, Katrina, coming on this, I mean, BOE sounding a bit dovish, Bank of Mexico sounding dovish. The government has given that 4.4% fiscal deficit target as well. Does it embolden the RBI to do more? Let's say a couple of rate cuts more. And where are you on the growth argument here? Mr. KK Mistry said that he believes that the RBI's number may be a bit conservative. Aditi disagrees, of course, and with her reasons. What is your reason? Or what is your assessment?
So our expectation is that we will see growth actually not pick up as optimistically as what the RBI is expecting. We're looking at about a 6.4% GDP growth rate. I think it's going to be like quite a difficult operating environment. We know the challenges about exports, but of course, exports aren't that key economic driver for India. It's more about what's happening domestically. And I think 125 basis point cut doesn't materially change the game at this point. I mean, sure, we do have a bit more fiscal support coming on board, particularly particularly from April around those adjustments for middle-income households. But I think it's still going to be a challenging environment as well. And I think one thing and one area that, we don't pay enough attention to as we should is that, labor supply overseas and that flow through to remittances and then that impact on private consumption. I mean, if we do see a material pullback in labor supply of overseas workers in the US, then that could actually flow through to a weaker consumption picture as well in India. And of course, consumption is such a critical driver of the economy. So I think that's a risk that is quite frankly, flying under the radar at this point that we need to pay really close attention to. And I think in terms of how much more the RBI is going to move, I don't think we're going to see as much movement as what we've seen from other central banks like the ECB, the Fed, the Bank of England. I think they're going to tread a lot more carefully because the one complicating factor for the RBI when it comes to easing policy that these other central banks don't have as much is around the currency. And because we do have such a weak rupee, that potential flow through to imported inflation is a concern. And I think one thing as well that we need to keep a close watch on is, energy prices are low at the moment, but if we do get a resurgence at the same time that the rupee is extremely weak, then that's going to be particularly troublesome for an economy like India. So I think we're not going to see much more cuts. I think it's going to be a shallow easing cycle this year, which really does limit the revival in domestic demand that we will see as a consequence of that.
I want to get Aditi's view on this. What next? Because even from a market's perspective, we're now looking at what is the quantum of rate cuts that can be expected. And I agree with you when you say that the governor was very clear in pointing out potential trouble on the horizon, whether it's geopolitical or otherwise. Are you still penciling in, or are you penciling in 2 more rate cuts? And what is the quantum you're seeing this year?
We're penciling in 1 more rate cut.
Okay.
That's what we were penciling in before today as well. Quite frankly, if we were to be looking at 2 more rate cuts, then I think they would have changed the stance to accommodative. I'm not sure they would have continued with a neutral stance if they were going to be considering 2 rate cuts going forward. And that's why I think sticking with a neutral stance makes sense in this situation where if you're only going to cut rates 1 more time, why would you have moved to accommodative? And I know I said it before, I'm going to say it again, the focus on the upside risk to inflation, I think that's another hint that they're not looking at too many rate cuts going ahead.
But Jayesh, come in please. On that, the RBI unequivocally saying that we will take every quarter, assess the data, so on and so forth. If the monsoons are good, so and food inflation does get under control, does it open up the door, or are you also of the camp that it's probably just at best 1 more rate cut? Plus, couple that up, Jayesh, with what do you think is the bond yield trajectory for the near term? How do money markets see this policy and the upcoming belief about the policy?
So I think firstly answering the same as Aditi said, neutral means maybe 1 more rate cut. That's what the bond market thinks. Of course, I do have a slightly different view. In this uncertainty world, right, you can't give any directional stance on the policy, and that's why it's neutral. You want to be flexible within 15 days, even before next policy, if something happens, they want that flexibility. And that's why I would emphasize that neutral means something which is the global uncertainty. That's why it's a neutral stance and not on either way. Coming back to further rate cut trajectory, I do believe there is room to go, maybe more than 1 rate cut, maybe 2 rate cut. Assuming, see, as of today, we are looking at as of today, and even RBI is looking at as of today. That's why the neutral stance, because we don't know what happens in 15 days or next 30 days. So much of uncertainty in the world. But assuming that projection, which is there, nothing changes dramatically in next policy or next 2 policies, we will see rate cuts because if you really look at the growth projection has been reduced, inflation at 4.2 for next year gives almost 200 basis point real rate. Like, when your growth is lower, you can't have such a high real rate. Like there was a time we were focused on 1% real rate, and right now we are, last 1 year we have been at 2% real rate. So I think when the growth slows down, how to make sure the real rate also comes down. And that's where I see more room for them to cut, assuming that their inflation trajectory and their inflation projection pans out the way they have projected. Maybe 10, 15 basis point doesn't matter, but along that lines, it should not be that 4.2 becomes like, in next policy, the projection becomes maybe say 5% or 5.5%. That is a different situation. So looking at the current scenario, there is enough room for a rate cut further.
Mr. Mehta, I just wanted to get your take on the governor's comments on the currency. And he started by saying that there is a lot of commentary on the RBI's positioning on the currency. He goes and he took pains to say that we don't take any steps to intervene on the rupee vis-a-vis any other particular currency. What is your take on what you made of his comments on the currency and any cues from there on what the RBI's approach is going to be to a weakening rupee?
So I would say this is going back to the old RBI. There was some difference in the last couple of years, but it's the old RBI where currency, they were never targeting a rate, but it was more like targeting the volatility, right? If there's a large move, definitely they need to come in and intervene, and that's what they were doing. I think last 1 month, they've changed that situation, and even volatility is relative, right? Like, if the world has moved only by, say, I'm giving a very hypothetical number just to give an example. If the world has moved by 2% and if we move by 2%, that's fine. But if the world has moved by 0.2% and we are moving by 2%, that's excessive volatility. So that's how, as compared to the global currency movement, if we move in the same similar trajectory, they should be okay with that volatility. It's only when our currency has a dramatic difference as compared to the volatility of the world, they definitely intervene. So they are not targeting. Say earlier, the market was very sure there was this 84 buffer, then 84.50 break, 85.50 break. So there was this number. I never understood why that number thing, right? But there was always this number, 87, 87.50. So people were trying to do that. Now they are, beyond that, it's just compared to how the global currencies move, and then if that moves dramatically, we are okay to move dramatically. So that's the way I would look at it.
Yeah, well, maybe if the Chinese yuan is depreciating consistently, how can maybe the rupee not? But interesting point, Jayesh. Jaideep Iyer, we asked you a specific question around liquidity, but the overall budget, overall policy view, Jaideep, what do you make of the statements coming out? And do you reckon that again, a view around whether it's 2 or 1 or none?
Honestly, Neeraj, more than I think future rate cuts, as we discussed earlier, I was at least happy that the liquidity measures came first and then we've had a rate cut. In a normal environment, I would have expected and wished for more liquidity measures, more durable liquidity measures before rate cuts, because everybody would know that this is the first time where we have an externally benchmarked loan book for banks, largely on repo. And we have seen the first down cycle in rates. This is the first time after the regime change of externally benchmarked rates. So it's and we've not seen deposit rates materially come down. So it's from a pure banking standpoint, we would really prefer easy liquidity and therefore deposit rates at least directionally coming down before there are multiple rate cuts. So right now, given the circumstances of a relatively challenging macroeconomic environment, dollar rupee issues, uncertain geopolitical environment, I think this is the best we could get. But in a more stable environment, my wish would have been higher. So that's one. The second interesting point that I noticed was that the governor did mention the cost of stability, the cost of regulations. And I think this is the first time, at least I would want to interpret this statement positively from a banking standpoint, that that the regulator does, the RBI does recognize that there are significant costs attached to high regulations, which the banks have seen over the last few years. And maybe optimistically, one could therefore expect some moderation in the pace at which regulations have come.
Okay, Thank you so much to all of you for joining us today on our wrap-up and our assessment of the policy. No harm done. I think that's one big takeaway. 25 basis point rate cut as expected. A careful and very nuanced commentary on the outlook from Governor Malhotra, and also sets the stage of what to expect, that this RBI, the Reserve Bank, will be completely open to all kind of headwinds and threats on the horizon, if any, quick to react as and when they need to, but nothing to be alarmed about right now.
Yep, that's the long and short of it. With that, it's a wrap on this coverage of the RBI Monetary Policy Committee decision. Of course, the presser comes in at 12, and you might want to tune in for that as well. But up next, we get some of your queries answered with regards to the markets, which are doing okay.
भाषण सुना, उसके बाद मेरा पहला एक्रोनिम निकाला मैंने, वो था RRR, रिस्पॉन्सिबल, रिफॉर्मिस्ट, और मैंने कहा रिवॉल्यूशनरी। हाउ डिड यू अराइव एट दिस नंबर ऑफ 12 लाख रुपीस?
हमें लगता है टैक्स पेयर उस लेवल नंबर से टैक्स भर रहा है, क्या उनको हम कुछ कर सकते हैं?
प्राइवेट सेक्टर कैपेक्स अभी तक वो इन्वेस्ट क्यों नहीं कर रहे हैं, जबकि आपका इकोनॉमिक सर्वे ही बताता है कि वो कैश पाइल पे बैठे हुए हैं।
अगर कंजम्पशन बढ़ता है और उसके तहत लगता है कि ग्रेटर इन्वेस्टमेंट का पॉसिबिलिटी है, वो भी अच्छा ट्रिगर हो सकता है।
एआई बहुत तेजी से आ रहा है, तो जॉब के चैलेंजेस होंगे, स्किल के चैलेंज पहले से हैं, तो जो ट्रांजिशन पीरियड का स्ट्रगल है, नौकरी मुझे अभी चाहिए।
पूरे साल का एक्सपोजर दिलाने के लिए हम इंटर्नशिप प्रोग्राम ले आए, और इसके साथ साथ इस बजट में भी ट्रेनिंग फॉर एआई, इसके लिए सेंटर्स बनाए हैं।
Sources telling us is that government is expected to provide a roadmap of the next phase of national monetization pipeline, where they are going to set a higher target for the next fiscal onwards.
Building on the success of the first asset monetization plan announced in 2021, the second plan for 2025 to 30 will be launched to plow back capital of 10 lakh crore in new projects.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Hi, thanks so much for joining in. You're watching NDTV Profit. This is Ask Profit. My name is Alex Matthew, and with me is Mahima Vachrajani. And we've got lots to talk about, because just a short while back you had the first presentation of the RBI monetary policy by the new governor, Mr. Malhotra, and it was along expected lines. There was a cut in the policy repo rate by 25 basis points. Most people had anticipated this, and let's see how the market has reacted. It's I guess you can say that it was in the price, and to a certain extent that has played out, because the Nifty 50 is absolutely flat at this juncture. It wobbled a little bit, but it has recovered, and it's a very narrow range if you think about it from the start to finish. Remember, we closed at 23,603 yesterday, and it's more or less where we were yesterday as well. Let's talk about the broader markets, and you have the mid-cap index that's just about flat at this juncture, and the small-cap index, which is down about 0.5% or thereabouts at this point, or 0.33% or thereabouts. Let's talk about banks though, and the Nifty Bank is currently trading with cuts of just about 0.2% or thereabouts, and it's going to be interesting to watch how some of these names react over the course of today and of course in the coming days, as the liquidity scenario is something that is developing. It's still in deficit, remember, and the RBI is going to take all of the measures that it expects it will need to in order to maintain durable liquidity, is what the Reserve Bank of India Governor Sanjay Malhotra had to say in his first address as Reserve Bank Governor. We're joined today by Sameer Dalal of Natvarlal & Sons Stockbrokers, as well as Kushal Gandhi, who's technical analyst at Stocksbox. Thank you so much, gentlemen, for taking the time as always. Sameer, you were probably anticipating this, as were a lot of other people. Do you have any specific banks that you're looking at that will immediately look to benefit from this rate cut? I know a lot of them have been going a little slow on the unsecured side, which is where the real credit growth has been over the last year. So what are you looking for in the banking space?
So, the banking space, the stocks that we've identified and we discussed on your channel don't change. So we continue to like the likes of HDFC Bank, IndusInd Bank, IDFC First Bank in the private side, and on the PSU side, Bank of Baroda. Even though they didn't have the best of numbers, I mean, if you look at it, the pain points are over. We believe the growth opportunity will arise, and they are working on that. And that valuation comparatively are quite reasonable, so that remains that topic. So that doesn't change anything. Yes, it wasn't expected, I think, to a large extent that the rate cut would come. And government is already working on the liquidity. Before the rate cut, they already announced 150,000 crores of liquidity, which is slowly getting infused into the system. So as that continues to happen, hopefully the rate transmissions will happen. It's not going to happen immediately. But when the governor cuts, one thing everyone got to remember, that when the governor is indicating of a cut in the interest rates, he wants that transmission to eventually happen. So he will ensure that there's enough liquidity in the system. Does it change anything for the banking stocks right away? No, it doesn't. But yes, what we can hope is that the growth momentum, because lower interest rates heading down probably can drive some amount of growth momentum from companies who want to put in capex, thinking that, look, if interest rates are headed down, this is the time to start investing because growth will come back in a stronger way. So maybe from all those points of view, hopefully the growth picks up for the banking space as well.
Right, Sameer, just to add to that, IIFL Capital did come out with its first cut with respect to what impact this repo rate cut will bring on banks. Their analysis shows that NIMs will be impacted by 5 to 10 basis points, and they see relatively lower impact on the PSU banks, and they believe that impact of 25 basis points rate cut is already built in. So nothing much with respect to Alex, the stock performance is what IIFL Capital builds in. Let's move on to our first query for the day. Then we have this query is from Madan, who's from Hyderabad. He's holding Vatek Vabag 200 shares at 1550 a piece, and he's sitting at a loss of if you can pull up the number, there you go, 31,000, so 32,000 odd rupees, and he wants to know whether he should hold for the next 3 months to see some profits at least. Kushal, is that the right reading on the charts right now for Vatek Vabag?
Well, yes, a positive view on Vabag. I think the declines, they're showing some now minimal resilience. So I think that's a positive development. And over the last couple of trading sessions, you'll see, it's undergoing some nice accumulation phase. So the risk reward is also quite favoring, just in case he wants to average at the current market price. So I'm positive on the stock, hold it with a stop loss near 1292. And my target on the upside is 1683.
Okay, 1683 is a call on Vatek Vabag. Our first caller of the day, Asad, is calling us from Bengaluru. Hi, Asad. How can we help you today? Morning.
Yeah, hi, good morning. Yeah, actually I have the Samara Raja Batteries share for 1081. I have 50 shares. So basically want some insight on that, whether I need to hold because results are on tomorrow. So I just wanted to check whether I need to hold or I need to exit.
What was the thesis when you bought it, Asad? Did you buy it for the long-term prospects?
Yeah, my insight is for long term. The reason for buying is basically the PE has come down. I mean, comparatively when compared to Excite batteries, and considering the EV battery future, right? So I thought maybe I'll go with it.
Okay, all right. I'll come to you, Samir, on this one, on the valuations, and of course, awaiting the numbers that Asad is talking about. What do you make of this company?
We are positive on the entire battery space and especially even on Amara, right? We believe the entire EV space and which is going to see traction will see companies which are setting up these huge factories of lithium-ion batteries benefiting from that. Amara is one of them. Yes, valuations are not at all compelling. They're trading at 20 times trailing earnings, which is not expensive. Growth in the near term may be a little subdued given the fact that we've seen a bit of a slowdown in not slowdown, but the growth has not been great for the automobile sector, right, in the current year. So growth for the battery segment also we believe will be a little subdued. So maybe this year we won't get, but once we see the pickup happening in the electric vehicle sales and they have their battery up and running, which is going to take another year at least, I think. I'm not sure of the timeline exactly at this point, but it's going to take at least another year. So maybe in the future you will see the earnings uptick coming quite strong. We have a buy recommendation on it and one should hold on to it. I wouldn't worry if you're a long-term investor, one result doesn't change anything, whether it's up or down. If it corrects, I would say add on to it from a longer-term perspective.
There is, in fact, a sharp reaction in the bond yield. From what I can see, there is a 15 basis point increase from the previous close on the 10-year. What you're seeing on the screen is the 7.1 coupon 2034, and there is an increase. It's currently at 6.75 or thereabouts, so it's cooled off maybe a tad bit. And maybe my feed on my phone is a little delayed, but there is no doubt a sharp spike in the bond yield. Perhaps to a certain extent, pricing in what will happen in the rest of the year, and also certain measures that the governor has announced that could have a bearing on how yields function. Of course, there was widely expected to be this rate cut. Maybe the projection on what is anticipated in the next year based on the projection for inflation is something that the street is looking at. And I'm talking about Mint Street here, not Dalal Street. And so bear that in mind. We will try and get you a sense of why the bond yields have spiked as they did. Of course, the rupee has not moved too much from where it was before the policy, but certainly the bond yields are going to be something that you should watch out for. Generally, you would say that if during a quarter there is a spike in bond yields, it has a bearing on treasuries for the banks, because a lot of these banks have a significant amount of a hold to maturity bonds. So the actual impact is not very significant, but they have to have mark-to-market addressing of these changes in the yields. When the yields spike, you generally see a fall in the face value or the price of the bonds, and that has a bearing on treasury performance during a quarter. So certainly something to watch. We'll get you a view on how that is. For now, let's turn to SBI for an intraday trade. Of course, you saw the results earlier in the week. In fact, yesterday, right? We had SBI results yesterday.
Yes.
The stock is down about 1% or so. I'll come to you, Kushal, on the charts. It's an intraday view that is being sought. What would you do here?
Pessimistic view from an intraday point as well. I mean, the stock has been trading with below the shorter term moving averages, and they're acting as constant supply. So my sense is, even if you want to place an intraday bet, it has to be about 752 on a closing basis on a 15-minute chart. Until then, it's an avoid.
All right, so that's the view coming in on SBI with respect to the charts. GE Shipping is the next counter. Sunita from Hyderabad is holding 20 shares bought at 1160 a piece. She wants to know whether she should book losses or buy some more stocks to average out at the current levels. What's the outlook with respect to this stock from a longer term perspective, Samir, if you have a view on this one?
Unfortunately, GE Shipping is something we don't cover, so I'll toss it over to you.
Okay, Kushal, with respect to the charts, how does the charts fare for GE Shipping? Okay, I believe we have an audio issue with Kushal right now. Let's move on to the next query. Then LIC is the counter. Praveen has accumulated 200 shares at a price of 1010 for LIC. His question is whether he can accumulate more or wait for some time for correction at the present levels. What's the view with respect to this, Samir, then?
We've already seen quite a bit of correction, right? He's already down 20% from where he bought it. So I think it's time to add on. Look, we remain positive on the entire life insurance space, and LIC is the largest player in the space with greatest reach. They have a lot of value in their investments, which they will keep unlocking over a period of time. Profitability will grow as we believe the markets will keep expanding in India over the next many years. They will stand to benefit from all of that intrinsic value that they hold in all their investments. Plus, like I said, look, India is a very underpenetrated market. We've discussed this in the past. I think we are at about 4 or 5% in terms of value when it comes to life insurance, whereas internationally that goes up closer to 80-90% also. So the scope to grow is great, and given their reach and their brand value, I think they will be able to do that. They're coming up with the right products over a period. They keep coming up with different things. Of course, the government has taken away a little bit of the incentive of these ULIPs and all these investment themes. But as the dust on that settles, I think people will continue to make these investments, because at the end of the day, everyone's looking at, if I'm putting in X, Y, Z, what am I getting back? And LIC has some of the best products for that. So I think it will do well, and you can add on.
All right, add-on is the view coming in on LIC from Samir. We have our next caller, Pradeep from Kerala is calling in. Pradeep, a very good morning to you. How can we help you?
Hello.
Hi, Pradeep. Go ahead with your query, Pradeep. I can hear you. Okay.
Hello.
Yes, Pradeep, I can hear you. Go ahead with your query.
Hello.
Okay, I think there is some problem with his audio, but I believe he's holding NCC 2000 shares bought at 309 a piece, and he's sitting on a loss of roughly 1.9 lakhs. Samir, your view on NCC, whether he should keep holding it and whether his losses will reverse, or should he exit and book the losses?
I think he can continue to hold on. Look, the entire infrastructure space in India is going to see a lot of momentum. NCC is doing the road projects, doing certain other construction activity projects, which they have a decent order book. They've, of course, the last quarter results. Today the stock is down because the quarterly results were not the best in the sense that the growth was not that great. The profitability and margins took a bit of an impact. We believe all of that will reverse over time. Look, we've also had a year where the government has been a little slow in generating orders for the infra space. And that we believe will also start reversing in the month of March. And then when we have the next year coming on. So overall, as long as the order book continues to go, which we believe they are competitive with, the stock will continue to do well. It's trading at 18 times earnings. I will not say it's cheap for a construction company, given they work on thin margins, but given the growth opportunity and given the quality of the balance sheet, I think one can hold on. If it comes down a little further, again, closer to about, say, 180, you can buy some more and average up a bit.
All right, so hold on and average out at 180 levels is the view coming in for NCC. The next counter that we're talking about is NMDC. Robin from Bengaluru has bought in some quantities in this particular counter. He wants to know what will be the movement with respect to this counter on the charts. Kushal, I'll come to you. NMDC, what are the support and resistance levels that you're watching out for?
Yes. In NDTV, the immediate support comes near 63.05. Immediate resistance is 68.93. So I think a decisive closing about 68.93, will confirm a double bottom pattern that is evolving. And also 69 levels is where you find the 50 DMA. So I think that zone holds a very critical resistance. So a close above that would attract further bullish momentum.
So that's the view coming in on NMDC. We have our next caller. Rajan from Mumbai is calling us. Rajan, a very good morning to you. I believe you have a query on Zinka Logistics.
Good morning, madam. Yeah, I am Zinka Logistics. I was allotted in IPO in November 2024. I would like to have the views of both the analysts in case one of them is not having the IPO view. I am a long-term investor ready to hold for 3 years. Kindly explain me the prospects of this company.
Got it. Rajan, I don't think we'll have enough data on the charts for Zinka Logistics yet because it's just newly listed. But Sameer, if you have a view on Zinka Logistics as well as the entire space, if you can give a perspective.
So sadly, Zinka Logistics, we don't have a view, and I'm not even sure what part of the business they follow. So I don't know which part of the logistics are part of the business you want me to address.
So Zinka Logistics is basically into digital trucking platform. So they give telematics, load marketplace, vehicle financing for trucks specifically.
So, a similar company which does some of that is Tata Technologies. I mean, they have these apps and softwares which can help you track some of this. So that is a counter we do cover. We remain positive on that. The stock has seen a very significant correction, and the correction has rightfully come because, growth has been subdued. Again, I've been talking about the fact that it's not only the logistics are part of it that they do, but they also have other parts of the businesses, right, which cater to car sales, the automation and the electronics and all of that go into the car. So once we see auto sales picking up, we believe that is one of the counters that will do well, but it's again very small, the percentage of the part of the business of Zinka probably that is doing. So it's not a direct comparison on that one.
All right, Sameer. The next query that we have is on MobiKwik. Do we have the name of the, yes, Varun. Varun is from Karnataka, is holding 650 shares of MobiKwik, bought at 540 a piece. He's sitting on a loss of more than 90,000 is what he's saying, because the current market price is around 393. When can he expect a recovery in this stock is his question. Sameer, by any chance, do you have a view on this one?
These platform companies will gain more traction. So I think, look, the results were not the best again in this quarter. I think once the entire space sees more and more traction happening and more of these payment systems getting on, we will see the operating leverage play through. So if you want to be invested in a company like this, I think you got to be invested from a 3 to 5 year perspective, minimum of 3 and on the upper side 5. So if you do have that kind of timeline, yes, you could recover your money in the short term. I think pain will probably still persist.
Got it. The next query that we have is on ONGC. The viewer's name is Sharwani Reddy. She wants to know whether she can keep holding ONGC for the next 3 months. Kushal, on the charts, ONGC, how does it fare? Okay, I think Kushal, we are having problem connecting him.
I believe we've got Ajay Manglunia who is logged in and who's joined us on the phone line, I believe, Managing Director and Head Fixed Income at Incred Capital. Ajay, just trying to understand the reaction in the bond markets. I may have read it wrong in terms of the increase in the bond yield. So can you clarify which, so there is an increase in the bond yield. So what are you reading in terms of the immediate reaction, Ajay, and how do you explain it?
So market was kind of expecting a token rate cut, which was delivered in the today's MPC meeting outcome. 25 basis point rate cut is something largely was expecting by the market, and it's after a very long time, 5 years later, there is a rate cut in Indian environment. What market was disappointed was some answer to the liquidity. Market was expecting that there could be some kind of a delivery on the liquidity front, which was kind of kept silent, and we have seen that RBI has kind of been doing enough in terms of providing liquidity. Market might be expecting a longer durable liquidity, since we see a lot of liquidity deficit in the market, and that's what is kind of disappointed in the yields in the government securities has gone up by 4 to 5 basis points. It's a knee-jerk reaction which we can say, and over a period of time we will see the moderation in the yields.
I just want to clarify, because I'm looking perhaps at the what is not the benchmark, what we have on the screen. What is the coupon on the benchmark right now, Ajay? Because we don't look at this very often. The 10-year benchmark, you're looking at 6.79?
6.79 is the new benchmark right now. Earlier it was 7.10.
Yeah.
So both are traded, but I think more volume is in the 6.69.
6.79. And do you anticipate that this will be something that eases over the course of the next few weeks as liquidity conditions improve?
Yeah, definitely. As we see the market in this security was trading in the range of 6.65 or around 2-3 basis points up and down. And today with the knee-jerk reaction with kind of no mention about the liquidity measures in the policy has disappointed a few traders, and they kind of book profit. It may kind of be somewhere about say 660 to 670 range for some time before it settles down at its own levels. I think 665, 663 is the level where we could see this being traded. February is the month where probably there is no major government borrowings, and as we enter into the next financial year, the borrowing will recommence from the next financial year in April onwards. So we could see some rally in this paper going forward.
Last point, Ajay, and a quick one. Right now, we've got a rate cut as was anticipated, but as you've pointed out, the street is reacting to liquidity. The base case assumption, as I understand it, is for another rate cut sometime this year. And would you say that once the liquidity scenario eases out, you could see a move down to the in the 10-year bonds, in the long-term bond yields? And when do you see that playing out?
Bond yields, as we have been talking about, is more of a stable. The immediate impact of the rate cut will be on the shorter tenor papers like CP, CDs, money market instruments will immediately have a transition for this rate cut. The next rate cut probably people might be expecting in the April, which is the next policy time, and by then we will see the new financial year borrowing will also commence. So we don't see huge rally in the 10-year. The rates might be stable. The more comforting factor with the market is likely to be stability. Stability in terms of liquidity, stability in terms of rate trajectory, stability in terms of currency, and all of these are basically points to watch out.
Fantastic. Thanks so much, Ajay, for joining us, for giving us that quick view. Just a small clarification. These are not bonds that you look at on a daily basis, as a result of which there would have been a little bit of a confusion. What you see on your screen, or you saw on your screen, was actually a 7.1% coupon, the earlier benchmark. Right now it is 6.79. That's where most of the trades are taking place. And the current yield on that paper is at 6.69, and it has moved up very sharply. You can call it sharply because it is a substantial move. 3 and 4 basis points in a day is actually pretty sharp, but it is likely to stay range bound, is what Ajay has just pointed out. Let's go to the next one.
Right. The next counter that we have is, Zentech is the next counter. Dhanush from Karnataka wants to acquire Zen Technology from a longer term perspective, that is 5 years, and he wants your opinion on this, Samir. Zen Technology is the counter, if you've studied the company.
Zen is something in our coverage universe that's not there, but I can tell you about the IT sector, where we believe that the entire space is very richly valued at this point of time. We've been saying that, look, everyone's factoring in a recovery in the US markets and growth will come back, and because of which the strong cash flows will start improving. But we are not as constructive on the recovery in the US market, especially in the IT side. We believe that if the US market goes through a bit of slowdown because of the impacts that Donald Trump is taking of cutting spendings in a lot of places, putting in certain amount of taxes, if H-1B visas rules change, all of those could affect, and valuations are fully priced. So no coverage on Zen, but a slightly cautious view on IT.
Okay, we have our next caller, Ricky from Mumbai is calling in. Ricky, a very good morning to you. I believe you have a question on Trent.
Yeah. Hi, very good morning.
Good morning.
Actually, I have 25 shares of Trent with an average price of 5,500.
Okay.
And yesterday there was a result of Trent.
Correct.
It has missed the estimate. Yeah, but there was very deep correction. So is it a time to accumulate more shares, or should I wait more for further corrections?
Correct. Samir, I'll come to you.
And I even want to know the technical view.
Sure.
I even want the technical view of
I'll take one fundamental view from Samir. Samir, Trent, he's bought it at 5,500. Should he accumulate more at the current levels? Because quite a bit of correction has taken place on this counter.
So yes, I agree. A lot of correction has taken place, but you also got to realize that the stock ran up all the way from 2,000 to 8,000, right? So we are just seeing a correction. But if you look at it from a year and a half ago, it's still up quite significantly. Okay, so why was there a correction in the stock price after a result where they delivered a 35% top line growth? Okay, so I'll try to answer it the way I understand it. One of the disappointments that we saw in the numbers, at least that I saw in the numbers, was that same store sales growth was a bit muted. It was in the single digits. For retail businesses, especially like the ones where Trend, where you're renting out space, the higher SSSG that you get leads to a huge jump in the operating leverage, which was missing. Secondly, the growth that has come from new store additions. New stores, when you add, yes, the top line may grow, but these stores take time to stabilize and become profitable, of at least anywhere between 3 to 6 months before they start breaking even. So you've probably seen a lot of growth in the top line because of that, not as much growth coming from the SSSG, the same store sales growth. And till the urban consumption sees a bigger uptick, I think that is that is the big concern, that if SSSG does not go up, then how do you justify these 80 times forward valuation multiples? So I think that is the reason we saw a correction. Should I continue to add on to the stock? I think yes, you can buy onto the stock. Look, the product that they have, the expansion that they have, and the different verticals. So Zudio is doing extremely well at the low end. You have Westside, which is fashionable but still very reasonably priced, and then you have the Star Bazaar, which is the FMCG part of their business, where they are also launching their own brands,
right,
which will continue to do well. So we think that it's a great 3-year play. One can add on from a 3-year, but expect it to be sideways for the near future.
Okay, fantastic. Thanks so much for that view. And Samir, Kushal, thanks so much for joining in. And that brings us to the end of this edition of Ask Profit. Completely out of time. Do stay tuned. Lots more coming up on NDTV Profit.
सुना उसके बाद मेरा पहला एक्रोनिम निकाला मैंने, वो था RRR, रिस्पॉन्सिबल, रिफॉर्मिस्ट, और मैंने कहा रिवॉल्यूशनरी। हाउ डिड यू अराइव एट दिस नंबर ऑफ 12 लाख रुपीस?
हमें लगता है टैक्स पेयर उस लेवल नंबर से टैक्स भर रहा है, क्या उनको हम कुछ कर सकते हैं?
प्राइवेट सेक्टर कैपेक्स अभी तक वो इन्वेस्ट क्यों नहीं कर रहे हैं, जबकि आपका इकोनॉमिक सर्वे ही बताता है कि वो कैश पाइल पे बैठे हुए हैं।
अगर कंजम्पशन बढ़ता है और उसके तहत लगता है कि ग्रेटर इन्वेस्टमेंट का पॉसिबिलिटी है, वो भी अच्छा ट्रिगर हो सकता है।
एआई बहुत तेजी से आ रहा है, तो जॉब के चैलेंजेस होंगे, स्किल के चैलेंज पहले से हैं, तो जो ट्रांजिशन पीरियड का स्ट्रगल है, नौकरी मुझे अभी चाहिए।
पूरे साल का एक्सपोजर दिलाने के लिए हम इंटर्नशिप प्रोग्राम ले आए, और इसके साथ साथ इस बजट में भी ट्रेनिंग फॉर एआई, इसके लिए सेंटर्स बनाए हैं।
And the reason for the success of the restaurant this magnitude, because people felt भाई का जिगर है, बिजनेस नहीं है इसमें। This is our time to not bend down to their accents and their foods and glorify it. It is our time to lift our own cuisine, our own culture.
1, 2, 3, 4.
Toughest person to cater for, to cook for, President Trump, Prime Minister Modi, या शाहरुख खान?
मेरा दिल जिसके पास है, शाहरुख खान।
You tweeted recently after President Trump won the election that can I make something for you?
So एक तरह की खिचड़ी है जिसमें आप मिक्स्ड मिलेट्स डालते हैं।
आपको ट्रम्प साहब को खिचड़ी खिलानी है?
हाँ, तो खिचड़ी खाना नहीं है।
What is the one vegetable you will never eat?
मैंने मेथी खानी बंद कर दिया है।
मतलब आप करेला, बैंगन,
I love करेलास।
Is considering to increase the custom duty on the imported finished goods ranging from consumer electronics to medical devices.
And to rectify inverted duty structure, I propose to increase the BCD on interactive flat panel display from 10% to 20%.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the big... Hello and welcome to KYC, a show designed to give regular investors powerful, actionable insights into the fundamentals of a single NSE-listed company every day. Well, today we're talking about Exigo, also known as Travenue, and what we're tracking today is, well, largely the company which is into travel and tourism. Well, now we do know that this particular company has also listed just last year. So there is a lot of interesting data that we can potentially put out for you. We start off with talking about what the company is all about. We have incorporated, rather it was incorporated in 2007, and the company runs an online platform, and many of you may be familiar with it as well, as it provides information as well as booking services for the travel industry. It also provides software development and maintenance services to its customers, and this bookings will involve bookings for trains, flights, buses, hotels, what have you. Now, in terms of the latest metrics, what we are seeing is that the monthly average user stands at around 87 million. That's around 8.7 crores, and well, users from about 2,400 towns uses the Exigo website. We also have deep penetration as far as the tier 2 and tier 3 towns are concerned. For the company, it stands at a little less than 94%. And the lifetime transacted users stand at around 41 million. So that's as far as what the company does and what it's all about. But I'm going to get in my colleague Mahima to tell us about how things can pan out for this particular company and how things have come through. So what we usually do is we talk about the various fundamentals of the company. This would include the income statement, the balance sheet, cash flows, return ratios, moving beyond the financial statements. We also look at the shareholding, what the stock has done, as well as what the street makes of it along with the valuations. So Mahima, good morning and thanks for joining in. Why don't you take us through the revenues first, and as well as the profitability for this particular company, and the several revenue streams in this case.
Right. So in terms of revenue, if we see the 9 months FY25 performance, they're already standing at 629 crores of revenue, which in FY24 they've done 655 crores. So they're nearing their FY24 mark, and there's still one more quarter to go. So they certainly outperform in FY25 as compared to the FY24 metrics. The 3-year CAGR for revenue has been 69% for the company. EBITDA has grown to 55 crores as compared to 43 crores in FY24. So EBITDA is already much higher than what they did in FY24. In terms of margins have significantly improved from 6.7% to 8.9% when it comes to the 9 months FY25 figure. And net profit, however, has come down, and this is because their advertisement expense overall has gone up. In terms of multiple revenue streams, since it does bookings from different aspects, flights, trains, hotels, etc. They have agent services charges, they have payment gateway charges, value-added services, advertisement income, airline commissions, and convenience fees are some multiple sources of revenues, which kind of augur growth for the company. In terms of key operational metrics, the gross transaction value was up 48% YOY this particular quarter, and monthly transacting user was also up 38% for the company this quarter. So both of these combined, the gross transaction value as well as the monthly transacting users is what has kind of aided the revenue for the company, Agam.
Right. So that's, talking about the income statement. Let's also talk about how things have panned out when it comes to the balance sheet. And it's on a strong footing. To be honest, I wasn't expecting a company which is relatively new to the scene and, of course, very, very new to the stock market, certainly, to have such a good balance sheet. So it's debt-free. It does have about nearly 600 crores as shareholders' net worth. This is, of course, accumulated, profits as well. And cash at bank stands at around 143 crores, even as it sees a negligible gross debt currently. So it does seem like it's on a very strong footing if coming down to the balance sheet. And I'd reckon it is largely the same for cash flows as well, Mahima.
Absolutely. So in terms of cash flows, the cash flows have improved, when we compare the first half of FY25 versus the first half of FY24. In terms of cash flow from operations, it stood at around 19.4 crores in first half of 24, which is more than, more than tripled in first half of FY25 to 70 odd crores. And in terms of net cash flows, which was negative in first half of FY24, has turned positive to 28 crores in the first half of FY25. So, this financial year has turned out to be a good year in terms of cash flow as well. So we give a thumbs up in terms of cash flow as well.
Fair enough. So actually, if you consider all the three financial statements, they look very, very good. And based on that, I'm going to come down to return ratios. So return ratios are improving. There's no doubt about that. But they are not to the tune of 20%, 25% is what we might expect from an ideal situation. But we're not going to give that a thumbs down just because those ratios are down, or rather not up to the mark, because we have seen these ratios move from the negative well into on their way to hitting that 20% mark around there. So as far as the return on capital employed is concerned, at the end of 2024, that stood at nearly 17%. Return on assets stood at around 12.5%. This is coming from the negatives. So, which is why, they've seen an improvement. But once we see the company hit 20% mark, well, we'd probably give that a thumbs up as well. For now, we're going to go with a neutral. But Mahima, let's talk about the shareholding as well. This one is a very interesting one for this particular company.
Absolutely, because there's no promoter shareholding in this particular counter. And which is why, we'll probably give this particular metric a neutral rating, because there's no skin in the game when it comes to the promoters, right? But we've seen that FIIs have been increasing their stake. Their stake has been increased from 59.8 to 61.1 in December 2024. DIs have seen a slight downtick in terms of their stake, but public holding has kind of remained strong. Slight downtick seen with respect to September 24 and when you compare that to December 24 quarter. But in terms of an interesting thing to watch out for here is that both the CEO as well as the co-CEO and the director of the company are holding quite a significant stake in the company. Alok Bajpai, who's the CEO of the company, not the promoter of the company, holds 4.86% stake, so almost a 5% stake in the company. And Rajneesh Kumar, who's the director and group co-CEO, is who's again not the promoter of the company but holds around 5.21% stake in the company. So both of them combined are holding around 10% stake of the company, Agam.
Right. And this is an important one. And while the founders, the co-founders do have stake in the company. A lot of the decisions will come down to the influence of all the institutions who hold, significant amount of ownership in the company as well. Of course, one might find it heartening to know that the co-founders still have a significant stake, but again, it's going to be something of, middling in terms of our ratings as far as the shareholding is concerned, which is why it's a neutral. But we move on and talk about street credentials. And, well, the stock has done well. I would say that, again, we don't have too much data to move around with, considering it was listed back in June of 2024. So from its issue price, if you was subscribed for the IPO at that point in time, and if you were issued the share price, the shares, which was at around 93 rupees per share, you're looking at a 69% return. But even if you consider and would have bought the company on the listing day, it's given you 17% returns from the closing on listing day all the way until now, and which is not bad. So it has, to a certain extent, also outperformed the benchmarks, the mid cap and the small cap indices. So it's going to be a thumbs up there as well. That said, again, Mahima, let's talk about the valuations here. They do look very, very expensive.
Right. Before I go to valuations, the 17% mark is despite the kind of correction that the market has seen in the past, 1 month or so.
Yeah.
So that's why we've given thumbs up when it comes to the street kit. But yes, valuations does not paint a very rosy picture. If you compare it to the peers, Exigo is right now trailing at a P of 131 times. So despite of the kind of growth that we've seen in the company when it comes to the revenues, which have grown at a CAGR of around 69%, the stock has seen a lot more traction as compared to the growth of the company, which is why we're seeing the trailing PE at 131 times. Now that compared to its peers, TBO Tech trades at around 81 times, EaseMyTrip trades at 26 times, and Yatra Online trades at 81 times. So right now the only cheap option, comparatively cheap option available in the market is Easy Trip Planners. But yes, valuation is definitely a concern, which is why we've given a thumbs down for this particular metric.
And of course, we must remember that these are trailing 12-month valuations. Now, no matter what kind of growth we can see the company, even if they do double their bottom line over the course of the next 12 months, even based on that, you're looking at a price to earnings ratio of around 65 times.
Right.
So it is slightly on the higher end. But finally coming down to the analyst recommendations now. Well, given the fact that it's a relatively newer stock on the stock exchanges, we don't have a lot of coverage on the stock. Also, in terms of absolute size, it's not a very large one in terms of market capitalization, which is why we just have two analysts on the street at the moment, at least as far as our consensus is concerned, who have a buy rating with an upside potential of around 11%. And because of the fact that there is a relatively lower number of analysts covering it, we'll give it a neutral rating, and that brings us to an overall rating of around 5.5 out of 8. So there you have it. That's the rating coming through. But do remember that so far the company has done very well in terms of its key financial statements. That includes income statement, the balance sheet, as well as the cash flow statement. Of course, we'll continue to keep an eye on the several other factors. But Mahima, on that note, thanking you for joining me and taking us through these ratings for the company. And we'll move this conversation forward. We are now in conversation with Alok Bajpai. He's the chairman, managing director, and group CEO of Exigo. Alok, good morning, and thank you so much for joining in. Alok, we've seen what you all have done over the past few years, over the last 9 months as well. The question now comes down to, how are we looking at growth over the next 2 years?
So if you look at the Exigo story, right, it's a bit unique in some aspects because we did not start out as an OTA when we launched back in 2007, and the journey over a decade that we've had by serving the next billion users and building out utility use cases on trains, buses, and then becoming transactional just before COVID. I think that was a transformational moment for us because we already had a lot of traffic, and we started serving our customers better by helping them complete transactions on our own platform and build value-added services on top. So, our trajectory on revenue is reflective of the fact that, we've been working very hard on converting ourselves from, pure play utility app that we used to be many years ago to a transactional one. And therefore, our monthly active users were growing, but our MTUs also started to grow, and we started seeing transactions ramp up across train, bus, flight. And we did a couple of smart acquisitions during COVID as well, which and one more recently, which have also sort of aided this kind of growth. But if you look at the overall trend line on that growth, right, and you zoom out a bit, you see that last quarter, our revenue run rate, if you look at the annualized number on that, is almost 10 times of what our revenue used to be back in 2019 pre-COVID, right? And so it's not just a doubling over the last 2 years, but it's a trend that's been on for the last 5 years, where we on the top line level. And I think the only thing that has earned us that is the fact that we've been extremely focused on customer experience with a specific focus on the next billion users.
Right, Alok. So, moving you towards a transactional app from a utility app right now, keeping all these factors into consideration with the kind of trends that you all have seen over the past few quarters and years, how does this product mix change over the next few quarters and years as well? What can you tell us about the latest changes that are taking place as far as your company goes?
Yeah, so I think the shift you're referring to is more on the product mix, right? Like how people are increasingly buying flights and buses through Exigo. I mean, trains, we were already the market leading OTA with dominant share. And I think that share has also moved up. We were close to 58% of the online travel agent train booking market as of December, right? And I think bus and flight is where we've really doubled down. And if you look at our flight growth, 73% GTP growth year on year. I mean, just for perspective, the overall domestic flyers grew by about 11% during that quarter, right? So we've actually grown almost 6.5, 7 times faster than how fast the overall sort of passenger market is growing there. On buses also, we've grown at 63% YOY last quarter. And if you understand why this is happening, it's kind of natural in my mind that this is something that, we have a right to grow faster on, because we are starting from, people in tier 2, 3, 4 towns who maybe earlier were only taking trains or buses, and now today, are coming and actually booking flights. And even though we don't disclose these numbers, but there's a large chunk of these who might even be flying the first time of their life, right? And I think the interesting thing is, if you're adding that many new flyers, right, and you're seeing them come from places like Gorakhpur or Varanasi or Ayodhya or Nagpur, Jaipur, right, and also doing international trips, some of them, right? So I think that's where the Exigo journey has been, really doubling down on. And if you again think about the macro trend, right, the per capita incomes in our country are going to continue improving. The aspiration levels of the middle class will keep growing, right? And if you just think of where will the next 100 million flyers in our country come from, I mean, the clear answer is they're going to come from people who today are not flying yet. And therefore, not that they're not traveling yet, they'll be traveling on buses and trains already, right? So in that sense, the nature of the audience we've built out over the last decade fits beautifully with where the apex velocity of growth will come from in the flight segment. And we are natural beneficiaries of that, right? And of course, I'll give a lot of credit to the execution of the team that has built a super product. We have market leading features out there, right, in terms of being able to track flights in real time and get updated about your boarding gate, or your that your flight is running delayed, or that your baggage has arrived at a certain belt number. So we really handhold the customer end to end. Our customer service is fantastic, and we are probably the only OTA in the world disclosing things like how fast we refund customers, how fast we pick up calls, right? 92% of our calls, actually close to 94% of our calls last quarter were picked up within 2 minutes. That number improved from 92% the quarter prior. And if you look at the average refund time that we have, 3.5 hours, right? I mean, when we were becoming an OTA, the biggest grouse we heard was people would not get refund and they would have to call up someone, email someone to get their money back, right? Their hard-earned money back. And we said, this is something we got to change, right? And that's why we started disclosing these metrics to put that pressure on ourselves to continue improving them. So we've been very fanatic about customer experience, and we will continue to use that strategy to grow faster.
Right, so Alok, the travel and tourism sector is ever evolving, also changing very, very quickly. Want to ask you now about the areas of businesses that you aren't at the moment, but will look to move into or are already planning strategically investments into.
See, hotels, we've been talking recently about that it's a area of priority for us. We recognize that for most OTAs out there, hotels is a sizable chunk of their revenue, GTV, etc. And globally, in fact, the established template globally was you launch for flights and you build hotels out, and that's how people used to build OTAs. It's just that in India, only 4% of people fly. So our strategy was to go after train and bus with equal fervor and sort of build those out, because you want to tap into the middle class. You want to start with train, and as that person graduates up into flights, hotels then becomes an important leg, because naturally when you know that somebody is going at from A to B and then staying in B for like 3 days, they would need some kind of accommodation, right? So that's why we've been kind of doubling down on building the right product, on getting the right supply, all those things in the last few quarters. And I think over the next few quarters, you will hear more from us around that. It's too early to talk about more details there. And, again, ancillary like value-added services that we have, whether it is Exigo Assured, Price Lock. Recently, we launched Travel Guarantee, which basically gives you up to a 3x refund if your waitlisted ticket on train doesn't confirm, so that you can buy a flight or a bus instead, or even another Tatkal train. I think those kind of products, we'll continue sort of innovating and coming out with. If you look at our track record in the last 4 years, we've come out with a bunch of these, 5 to 6 of these, right? And I think each product solve customer problems as well as improve, our ability to monetize.
Right, Alok, we've run out of time on the show, so I'm going to take a moment to thank you for joining us and taking us through the outlook for the company. Well, on that note, that is all that we have for this edition of KYC, but lots more lined up on the other side. You're watching NDTV Profit.
बजट भाषण सुना, उसके बाद मेरा पहला एक्रोनिम निकाला मैंने, वो था RRR, रिस्पॉन्सिव, रिस्पॉन्सिबल, रिफॉर्मिस्ट, और मैंने कहा रिवॉल्यूशनरी। हाउ डिड यू अराइव एट दिस नंबर ऑफ 12 लाख रुपीस?
हमें लगता है टैक्स पेयर उस लेवल नंबर से टैक्स भर रहा है, क्या उनको हम कुछ कर सकते हैं?
प्राइवेट सेक्टर कैपेक्स अभी तक वो इन्वेस्ट क्यों नहीं कर रहे हैं, जबकि आपका इकोनॉमिक सर्वे ही बताता है कि वो कैश पाइल पे बैठे हुए हैं।
अगर कंजम्पशन बढ़ता और उसके तहत लगता है कि ग्रेटर इन्वेस्टमेंट का पॉसिबिलिटी है, वो भी अच्छा ट्रिगर हो सकता है।
AI बहुत तेजी से आ रहा है, तो जॉब के चैलेंजेस होंगे, स्किल के चैलेंज पहले से हैं, तो जो ट्रांजिशन पीरियड का स्ट्रगल है, नौकरी मुझे अभी चाहिए।
पूरे साल का एक्सपोजर दिलाने के लिए हम इंटर्नशिप प्रोग्राम ले आए, और इसके साथ साथ इस बजट में ही ट्रेनिंग फॉर AI, इसके लिए सेंटर्स बनाए।
This entire special package and measures are kind of focused on AI skilling and how to sort of facilitate the AI centers which is existing at this point of time.
Now a center of excellence in artificial intelligence for education will be set up with a total outlay of 500 crores.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in?
Hello and welcome. You're watching Markets at 12 here on NDTV Profit, and this is Harsh Saita. Let's take a look at how markets are currently doing. Well, the Nifty now just off the day's high, so positivity starting to creep through, it seems. 1/5% higher on the Nifty, and we're just about at the 23,650 mark. The top is just below 23,700, so that's something you may want to keep your eye out on. Let's also look at what the Nifty Bank is doing, because it's a rather big announcement with regard to where the Nifty Bank is concerned. Plenty of choppiness in that index while the policy statement was on, and you can see that choppiness on the graph in front of you. But 0.1% lower is where the Nifty Bank is currently settling in at. So a muted kind of response from the Nifty Bank. Within the PSU banking pack though, the response is even lower, 0.6% lower on the Nifty PSU bank. The private banking index doing relatively okay in that sense, absolute flat line where the private banking index is concerned. Let's look at some other indices in focus. The Nifty Auto is up around 1% thereabouts. You're also seeing very good traction on the Nifty Metal, 2.5% higher on the Nifty Metal in fact, and 1.5% up on the Nifty Consumer Durables Index as well. So those are some indices which are doing decently okay in trade today. What's not doing well, the FMCG index. We spoke about the PSU banking index and the IT index, kind of a muted move on that one. The FMCG index is down around 1% thereabouts. What are broader markets doing? Let's pull up the advanced decline first off to start off with. Thereafter, let's look at the Nifty mid cap. And while we are at it, we'll also have live visuals for you very, very shortly on the press conference post the RBI MPC. Those live visuals on your screen as we speak. But the Nifty mid cap up around 0.5% thereabouts. The Nifty small cap index also absolutely at the flat line. Okay, let's go across. So maybe another minute or so before we cut across to the post MPC press conference, and of course the first press conference which will be presided by the new RBI governor, and let's cut across to that.
You may please exit from the right hand side, please. Thank you.
would be curious to know, is there a possible second rate cut, and how quickly will that happen? What are the liquidity measures that the RBI is poised to take? And all of that and more, of course, as part of all this, all the Q&A that will go around over the next hour or so.
Hello,
interesting one.
Good afternoon. Welcome to this post-monetary policy conference, first of this calendar year 2025. Friends, we have with us Governor Reserve Bank of India, Shri Sanjay Malhotra, Deputy Governors Shri M. Rajeshwar Rao, Shri T. Ravi Shankar, and Shri Swaminathan J. We also have with us Executive Directors Dr. O.P. Mal and Dr. Rajiv Ranjan and other colleagues from the Reserve Bank. To begin with, as is the practice, I'll request Governor to make his opening remarks. After that, we'll have the question answers. Governor, sir.
Well, good morning, good afternoon, and welcome to this press conference. I already made my statement, which we have also uploaded, and I'm sure you would have already gone through it. I do not have anything more to add. The MPC resolution, the rationale for it, and some of the other additional measures that we have brought in are very clearly communicated over there. So I think we can directly move towards the Q&A. I think that will give more time for all of you to ask additional questions. So we can begin, I think, with the Q&A directly.
Thank you, sir. Just before we begin, a couple of announcements as always. I'll request you all to please wait for your turn and restrict to one question per person. And if time permits, we can always go back for the other one. So you can see my colleagues on the aisle with mics in their hands, so they will give the mics to you. So please speak in the mic so that people outside can also hear you. So there are 27 participants from the media today, and with your permission, I'll call out their names. I'll request Lata from CNBC to ask her question.
Thank you, Governor and Deputy Governors. So I just want to first clarify a language part and then my question. Because in para 7, where you are announcing the rate cut, you say that the MPC remains unambiguously focused on durable alignment of inflation while supporting growth. So inflation first, then growth. In the immediate next paragraph, you are saying the growth inflation dynamics open up policy space for the MPC to support growth while remaining focused on aligning inflation. So should we read this as deliberate or casual? And the question I have is, rate cuts normally get passed on when liquidity is surplus. So would your stated policy be to keep liquidity surplus in the interbank system or just adequate? Thank you.
So let me come to your second question first. I think that was attempted in the statement also that we made. And you would have observed in the last couple of months and even before that, that it has been the endeavor of Reserve Bank to provide as much liquidity as is required. And when we say liquidity, as I also mentioned in my statement, it is both, overnight as well as durable liquidity. We have taken a number of steps. You are aware, that we introduced, perhaps for the first time, a regular pre-announced every day overnight repo rate operation. So this was primarily to give confidence to everyone that this window is always available insofar as the transient or the overnight liquidity is concerned. Even for the longer term durable liquidity, we have announced steps of about 1.5 lakh crore. Some of it which have already been put into operation. 20,000 crore of OMOs have already been done. Another 40,000 crore later on. Today, we are going to have a 56-day VRR for 50,000 crore. We are always watchful. We'll be nimble. I want to assure that we'll be very, very proactive in providing whatever liquidity requirements are needed. That's one of our jobs, and we will do it. Coming to your first question, I really did not, understand as to what you are. Everything, every statement, every word that is mentioned in the MPC statement, and especially, the resolution, because you were pointing at the resolution, is very, very well crafted, thought out, and deliberate.
Thank you, sir.
Thank you.
Thank you, sir. Next will be Swati from Reuters.
Thank you so much, sir. So your growth forecast for next year is at 6.7%. This is yet again at the upper end of the government's range. They've given us a 6.3 to 6.8. And as we saw last year as well, RBI had to lower their projection towards the end. What gives you so much optimism on growth, especially when you're saying that, you remain neutral purely because inflation risks could come up again with the heat waves, etc. So what gives you the optimism on growth, sir? Thank you.
See, all the parameters we analyze very regularly, the high frequency indicators that we have, and whether one looks at agriculture with good reservoir levels, and I've made detailed assessments even in my MPC statement. You can go through them as to what are the reasons. Actually, they are all given over there. So, in interest of time, I am just shortly, very briefly indicating them. So, whether it is in terms of agriculture, whether it is in terms of consumption. Now, you also, recently had the Nielsen survey, the consumption numbers over there, at 7% plus, augur very well. And this is the kind or the range, of projections that we too have for personal consumption. And similarly, the manufacturing activity, is also kind of picking up. The PMI